Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're kicking things off with a pressing issue that's been on the minds of many Canadian homeowners: rising mortgage costs. Recent reports indicate that increasing interest rates are putting significant pressure on homeowners across the country.
That's right, Sandy. A lot of this pressure stems from the Bank of Canada's recent interest rate hikes, which have been implemented to combat inflation. These hikes have led to higher mortgage rates, affecting both new home buyers and those with variable rate mortgages.
It's a tough situation for many. As mortgage payments rise, some homeowners are finding it difficult to make ends meet. This is particularly concerning for those who already had tight budgets, as it could lead to increased financial strain.
Exactly, Sandy. It's important to note that while the goal of raising interest rates is to stabilize the economy, it does come with the downside of making homeownership more expensive. Some experts suggest that we could see a rise in mortgage defaults if the trend continues.
And with that, the risk of losing one's home becomes a reality for some. It's a reminder of how interconnected our financial systems are and how changes in one area can ripple through the economy, impacting people's lives.
The numbers are certainly concerning. According to the Canadian Real Estate Association, the average home price in Canada has not seen significant declines despite these pressures. This indicates that while sales have been impacted, prices are remaining stable, which could be due to a shortage of listings.
That's a good point, Steve. It seems that the lack of motivated sellers is playing a part in keeping prices steady. Many homeowners are holding onto their properties, perhaps waiting for a more favorable market before selling.
Yes, and this leads to a kind of stalemate in the market. Buyers are hesitant because of high mortgage costs, and sellers are reluctant to list their homes. It's a challenging time for anyone looking to enter or move within the housing market.
Let's dive into the latest insights from the Canadian housing market, where we're seeing some intriguing dynamics play out. According to LePage's latest house price survey and market forecast, home sales are on the rise, yet prices in major markets are stalling. The national aggregate home price held steady year over year at $816,500, slipping just 1.2% from the previous quarter.
That's right, Sandy. What's interesting here is the regional variation. While Montreal saw a solid increase in home prices, up 4.9% year over year to $635,000, Toronto and Vancouver experienced declines. Toronto's aggregate price fell by 3.5%, down to $1,114,900, and Vancouver saw a 3.1% decrease, settling at $1,195,500.
It's fascinating to see how different regions are responding to the current market conditions. In Montreal, the increase in inventory is creating a more favorable environment for buyers, especially as people return to the office and the city center becomes more appealing. But, as broker Chris Allard pointed out, core living remains out of reach for many workers earning between $70,000 and $140,000 individually.
Absolutely, Sandy. And in Toronto and Vancouver, the market seems to be in favor of buyers. Active listings have increased significantly, giving buyers more negotiating power and choice. This shift is further supported by the Bank of Canada's recent rate cut to 2.5%, which offers some relief to borrowers by bringing mortgage rates back into the threes.
Phil Soper from LePage mentioned that the housing market is shifting towards balance, with easing prices, rising listings, and renewed rate cuts improving affordability across most regions. There's a sense of cautious optimism as we head into early 2026 with expectations of stronger activity by spring.
Yes, but Soper also noted that while the bank's rate cut is easing pressure on borrowers, it's not a magic bullet. Prices are expected to rise just 1.0% in the fourth quarter, reflecting ongoing softness in key markets like Toronto and Vancouver. It's clear that policy shifts and economic factors are shaping the market outlook.
And let's not forget Ottawa's Build Canada Homes initiative, which aims to introduce 4,000 factory-built homes. Soper sees this as a catalyst rather than a solution, emphasizing the need for meaningful private sector participation to meet housing demands. It's a complex situation with no quick fixes, but there's hope that improved affordability and lower borrowing costs will draw more buyers back into the market.
Indeed, Sandy. The return to office trend is another factor to watch. While it might renew demand in urban cores, the affordability issue means many are still looking to suburban and exurban areas. As broker Chris Allard highlighted, unless borrowers are further along in their careers, living in the core remains financially challenging, so the demand for properties outside urban centers is likely to persist.
We're hearing from Royal Bank of Canada that the Canadian fall housing market is off to a quiet start. Despite some cities seeing a slight uptick in resales, most areas have experienced a decline. This comes even as prices have lowered and interest rates have fallen in recent months.
Yeah, Sandy, it's interesting because you'd expect lower prices and interest rates to spur more activity. But it seems a portion of buyers are holding off, waiting for prices to fall even further. Others are struggling with affordability and are cautious due to the current economic climate.
And then there are the sellers, Steve. According to mortgage wellness broker Nick LePage, there's this group of sellers who aren't in a rush to sell. They're sticking to their original listing prices despite the lack of buyer interest, which is keeping the market activity muted.
Lequier makes a good point. He suggests that the inventory numbers might be misleading because not all sellers are serious about selling. He estimates that out of the reported 7 months of inventory, only about 4 to 5 months are made up of motivated sellers. The rest are those holding out for higher prices.
That's concerning for the market's health. If sellers aren't adjusting their expectations, it could delay a recovery. Robert Hogue from RBC highlights that regional trends are diverging, with buyers gaining leverage in Toronto, but supply is tight in Montreal and affordability remains an issue in Vancouver.
Right, and RBC doesn't foresee a national bounce in activity soon. They expect these regional differences to persist into next year. However, if the economy stabilizes and the labor market improves, we might see more activity.
Lecuyer believes that lower mortgage rates could eventually bring first-time buyers and younger Canadians back into the market. If they start buying, it could boost sales growth and eventually lead to price growth.
That's a good point, Sandy. With rates expected to hit the mid-threes, it could make buying more appealing. For those in a position to buy now, especially if they're purchasing a home to live in, it's a solid time to enter the market. Prices have adjusted, and interest rates are becoming more reasonable.
Let's dive into Canada's hottest real estate markets right now, as reported in recent updates. It seems the traditional powerhouses like Toronto and Vancouver are no longer the automatic go-tos for investors and buyers. Instead, we're seeing a shift towards less conventional areas. This is largely due to the high prices and lower returns in these traditional markets.
That's interesting, Sandy. It looks like buyers and investors are starting to focus on emerging markets. The factors driving these hot markets include a combination of limited supply, increased demand, and economic diversification. We're seeing places like Saskatchewan and Alberta rise in prominence.
Exactly, Steve. Take Saskatoon, for instance. It's benefiting from its strong research community and resource-based industries, with home prices rising by 8.2% year over year. Regina is also on the radar with its strength in mining and agriculture, showing signs of steady price increases due to growing demand and limited inventory.
Alberta's market, particularly in Edmonton, is another hotspot. It has seen a 5.3% annual price increase in detached homes as of August 2025. The city's affordability and job growth in energy and technology sectors are making it an attractive destination for new residents.
And let's not overlook Manitoba, where Winnipeg's home values have increased by 8.1% year over year. The city's strong agricultural base and manufacturing center make it appealing for those seeking economic stability. Plus, it offers a vibrant lifestyle with great food and outdoor activities.
Then there's Atlantic Canada, where Newfoundland and Labrador are leading the country with a 12.3% year-over-year increase in home prices. St. John's, with its relaxed lifestyle and proximity to Europe and the United States, is attracting both new and returning residents.
In New Brunswick, Fredericton and St. John are also seeing significant growth. Fredericton's home prices rose by 6.2%, while St. John experienced a 10.5% increase. These markets are becoming increasingly attractive due to their affordability and quality of life.
Quebec shouldn't be ignored either. Despite higher income taxes and potential language barriers, places like Quebec City and Montreal are thriving. Quebec City saw a 7% increase in single-family home values, while Montreal's prices hit an all-time high with an 8.9% increase.
Let's not forget Ontario, where areas like Peterborough and the Kawarthas are gaining attention. With a 3% increase in home prices, these locations offer reasonable entry points and opportunities in vacation and student rental markets.
And in Northern Ontario, Thunder Bay stands out with a surge in home sales and rising prices. It's clear that looking beyond the traditional hotspots can reveal promising opportunities for buyers and investors alike.
Let's talk about a new development that's generating quite a buzz in Toronto's East End. It's a 33-unit modular housing project at 355 Coxwell, a collaboration between the city and Habitat for Humanity Greater Toronto Area, supported by the New Deal from Premier Doug Ford and Mayor Olivia Chow. This initiative aims to create affordable housing by utilizing city-owned sites for modular homes.
That's an exciting development, Sandy. Modular homes are gaining popularity because they're cost-effective and environmentally friendly. They use prefabricated sections that are assembled on site, which speeds up construction and reduces costs. This project is part of a broader strategy by the government to address the housing crisis in Ontario.
Absolutely, Steve. The location at Coxwell and Gerrard is ideal, nestled between Little India and the Woodbine Corridor. The area is described as welcoming and family-friendly, with excellent public transit, parks, good schools, and community centers. It seems like a great place for families to settle down.
And the investment is significant. The province is putting in $10 million, while the city is contributing $4.8 million. It's a substantial commitment to making housing more attainable for middle-class workers, with prices reflecting the income of Torontonians in the 60th and 70th percentiles.
The building will feature a mix of 1, 2, and 3-bedroom units, with 22 of them being family-sized. The goal here is to make housing accessible to those who need it most, and the units will be sold at fair market value, with the purchaser contribution indexed to inflation.
It's an interesting approach, Sandy. By using surplus government lands and focusing on modular construction, this project could set a new standard for affordable housing in Toronto. It's encouraging to see initiatives like this that aim to meet the needs and budgets of everyday people.
And for those interested in these homes, Habitat for Humanity is handling the applications. Sales are expected to open in early 2026, with occupancy forecasted for mid-2027. It's a promising development for the city's housing landscape. As we wrap up today's episode, let's take a look at some interesting developments in the Canadian mortgage sector, specifically focusing on MCAN Mortgage Corporation. Recently, MCAN Mortgage's stock has been gaining attention as it strengthens on the Toronto Stock Exchange Small Cap Index. This is significant for those keeping an eye on mortgage-related stocks and the broader financial sector.
That's right, Sandy. MCAN Mortgage operates within various segments, including residential, commercial, and construction mortgages. Their recent performance on the TSX Small Cap Index indicates a positive market sentiment towards their strategies and offerings. It's a reflection of how well they're adapting to the current economic conditions and maintaining their relevance in a competitive market.
And it's not just about their performance on the index. The company's focus on diversified mortgage and real estate lending is a key factor in their success. By covering different sectors, they're able to mitigate risks and capitalize on different market opportunities. This kind of diversification is crucial in today's volatile economic environment.
Absolutely, Sandy. The fact that MCAN Mortgage has crossed above its 200-day moving average is a strong indicator of a shift in long-term stock trends. For investors, this suggests a change in market trading patterns, potentially signaling a good time to consider this stock. However, it's important for investors to conduct their own research and consider their personal financial goals before making any decisions.
Agreed, Steve. While the numbers are promising, it's always wise to look at the bigger picture. MCAN, Mortgage's market capitalization, which measures the total market value of the company's shares, is another metric to consider when evaluating its market size and potential.
Precisely, Sandy. As we discuss these developments, it's a reminder of the importance of staying informed about the companies within the sectors we're interested in. The mortgage and real estate markets are constantly evolving, and keeping up with these changes can help investors make informed decisions.
That's a great point, Steve. As we conclude this episode, it's clear that MCAN Mortgage's recent performance on the TSX Small Cap Index is a testament to their strategic approach and adaptability in the market. It's an encouraging sign for anyone involved in the mortgage and real estate sectors.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.